Hello and welcome to another edition of the China in Africa podcast, a proud member of the Sinica Podcast Network. I'm Eric Olander. Today we're going to dive in on what looks like a very important debt deal in Kenya, and there appears to be a lot of movement in the Chinese debt restructuring space. Now, this is a very important topic because close followers of the show and close followers of this topic will know that for much of the past 5 or 6 years, there's been this ongoing debate in Africa about restructuring Chinese loans. Now, Chinese loans, once upon a time, were a major part of the African debt portfolio. Today, we're looking at about 11% or less of the overall total public debt in Africa is owed to Chinese creditors. In Kenya in particular, the Kenyans have been trying for at least 5 or 6 years now to restructure some of the $6.4 billion of loans that they took out for the standard gauge railway. Well, we got news earlier this month that a major debt deal had been reached. Now, this comes only from the Kenyan side. The Chinese have not confirmed the details of this deal. So I want to be very clear on that we don't know a lot about it. But let me just walk you through what we do know. And we're going to dive into that today. So Kenya took out 3 loans for the SGR worth about $5 billion from the China Exim Bank. These loans were taken out in 2014 and 2015 and then came to maturity in terms of moving out of their grace period about 10 years later. So that's one of the reasons why we're talking about it now, in part because these loans are starting to kick in for the repayment period. Now, the Chinese have not restructured a lot of the Kenyan debt or any of the Kenyan debt up until now, in part because, well, the Kenyans had been paying their dues on time and servicing these debts without any problem. But when we talk about the SGR loans, remember, this is for that railway. It was a 600-kilometer railway that stretched from the port of Mombasa on the Indian Ocean all the way into Naivasha, which is the inland in the Rift Valley. It was supposed to go all the way out until the Ugandan border, but phase 3 of the SGR, which we've talked about in many other shows, was not financed by the Chinese as part of this, in part because of concerns about debt sustainability. So now we hear in October that there's about $3.5 billion left on these loans. And John Mbadi, who is the Treasury Secretary in Kenya, he confirmed that the Chinese have agreed to take this last $3.5 billion of debt and convert them from more expensive US dollar-denominated loans to Chinese yuan-based loans, which are apparently going to save the Kenyan Treasury about $215 million in interest payments. This is what they're calling a swap. Now, the term of the loans as well has also been extended. Now, that's coming from the president's chief economic advisor. Of course, that's President William Ruto, his chief economic advisor, David Ndii, who said that the term would extend. Now, that is a very common technique that the Chinese have been using in a lot of their debt restructurings. We saw this in Angola. We've seen it in Ecuador. And we're getting word from Indonesia that their $7.3 billion railway debt restructuring also will include an extension of the term to 60 years. Now, we got to be careful on this. Again, the Chinese have not confirmed this. And just as is in the case of Kenya, we're also hearing that there's a possible currency swap deal part of this and a loan extension. Finally, we're also getting word, again, all preliminary, nothing nailed down yet, that Ethiopia is talking about converting its $5.38 billion Chinese debt for its standard gauge railway as well from dollars into yuan. So this is a very, very interesting trend that's taking place, but it's also very complicated. And so we thought it would be great to dive into the mechanics of this with someone who knows more about this than pretty much anybody else out there. Yufan Huang is a pre-doctoral fellow with the China Africa Research Initiative at Johns Hopkins University in Washington, and seriously one of the world's most experienced and knowledgeable experts on Chinese lending and debt restructuring. And we are so grateful, Yufan, for you to join us this evening to walk us through what this all means.
Oh, thank you, Eric, for having me. Thank you for the kind words. I'm not sure I'm the most knowledgeable of these deals. But I mean, yeah, I think for the Chinese, they're not speaking about it, so so I'm here
Well, so
to
we'll
explain a
give you
little
the
bit.
credit for among the people willing to speak about it. You're
Yes.
among the most knowledgeable. So you're also quite modest about that. But let's dive into it. You told the South China Morning Post that this is a win-win-win for all sides. It's three wins. Walk us through who the three winners are in your view, and why they're benefiting from this deal in Kenya.
Yeah, sure. I mean, again, Eric, the details here matter. And a lot of details are not out yet. So, but just correct a little bit what you said earlier. So, for these loans, the repayment of the principal actually started in 2019 and 2020. Some
Okay.
of them at least, or they're repaid down 1.5 billion, right? For the 5 billion, they
Yeah.
will repay big part of it. So, the I think the key to understand here is that first of all, it was not the way I understand it from different hearing from different people is not that China reaching out to Kenya saying they want to do this deal. It's more like Kenya asking China for relief first, and then during the negotiation of the relief plan, they come up with this plan to do it. As you said, there are a lot of countries interested after hearing about some details of it that they lowered interest payment. So I know that a lot of countries are interested, including Ethiopia. So for the details here, when I say win-win-win, first of all, Kenya got some relief, right? Everybody knows that they're under stress, not just from the Chinese, but also they got bond payment dues in 2024, in 2027, 2028. So they've been trying to refinance those too. So for the case of China, they uh, they said they got 200 million of saving. But I think details here matter. The way I understand it is that they got three parts of loan, as you said. One, they were all originally in dollars. One was the fixed interest rate, 2%, and the other two are LIBOR plus interest rate. One's plus 3%, the other plus 3.6. Okay, I don't want to bore people with this detail, but the way I'm understanding the new deal, I think the details we still need to be waiting to be confirmed is that um, I believe they still got some. The fixed rate would still be fixed in RMB, and the LIBOR would be converted to floating rate in RMB. Again,
And
just
just for people
hearing
who are
different
not
things.
familiar, what is LIBOR?
So LIBOR is this benchmark rate uh, that measure the cost of banking borrow from each other. So it was it retired and used something called SOFR, SOFR, and measure the cost of these bank raising money, also opportunity costs. So often these Chinese loans, most of them at least, when they lend in US dollar, they lend is a LIBOR plus a profit margin. So what that means that when Exim Bank also borrow the US dollar at LIBOR benchmark rate, they will add this additional margin on top of that of their costs to make a profit from these US dollar loan, if that makes sense.
No, yes, it does. So you said the Kenyans are benefiting because they're saving potentially $215 million. Again, this is from the finance ministry or the Treasury Secretary, John Mbadi. We don't have a confirmation of that. Who is the second winner in all of this?
Yeah, before we go to second winner, I believe they also get some maturity extension, as the David Andy said. But I don't think it's a lot. It might be enough for them to pass the payment peak, the bond payment peak in 2027, 2028, but it wouldn't be a lot. So the second winner here, again, I would say is China Exim Bank, partly
Okay.
because they avoided a deeper debt rescheduling or reprofiling, whatever you like to call it. Because if they didn't do this kind of swap and just reschedule to the need of Kenya, they would have to do deeper maturity reprofiling, if that makes sense.
Yeah.
I think for Exim Bank too is that again the loss is not that big as a deeper reprofiling. Also because for this preferential buyer's credit that I talk about, one part of this big SGR loan is this 2% dollar loan. Um, for Exim, they are making a loss on these loans because they are raising money. They're raising US dollar at a higher cost. So for that part of loan right now converted to a RMB loan, I believe they make less losses on those. So they took some losses, but they also have some little wins with this swap. So I believe overall is that the kind of relief would have been much bigger if they didn't do this kind of swap and just reschedule. And the third win I would say just that the Chinese government, right? So they have some more progress on the RMB globalization. And again, the Chinese government didn't put big budget support for these kind of loans, for this kind of operation. So it's not like Chinese government telling Exim banks that, we're going to give you how much $1 million in budget support, and you do this. So for Chinese government, they got some progress without mutual finance have to step in to support the China Exim Bank, if that makes sense.
Yeah. So the three winners, just to recap, is the Kenyan government for saving its $215 or $200 million in interest payments, and also being able to stretch out the loan from, say, if it was, I don't remember what the exact term of the loan was. These are 15-year loans sometimes, or 20-year loans, but they're going to be able to extend it out another maybe 5 or 10 years potentially, and that would reduce their monthly payments. We don't know the details yet, but that's the idea, correct? And then the China Exim Bank wins because, well, they get to restructure now rather than potentially more painful restructuring later, even though what you're saying is that they're losing money on some of the dollar loans right now. So getting out of the dollars and into yuan makes more sense. And then finally, the Chinese government and its drive to internationalize the yuan. We got some questions on our LinkedIn page when we posted this, and somebody asked this very intuitive question, which is, well, if they're going to convert from dollars to yuan, presumably the Kenyans have to have yuan to make that conversion. How do the mechanics of this work? So if I have $10 and I want to convert this into yuan, is it simply that the Chinese government gives me the equivalent? I don't quite understand the mechanics of how this swap would work.
The way I understand is that they converted to the RMB according to exchange rate right now.
Right.
So the way exchange rate moves also affect, which is going to win more and lose more, right? So for example, one can imagine that if the RMB appreciate in the future, and if Kenya doesn't have any RMB reserves, it would have to use dollar to buy RMB to
Where
pay
would
those
Kenya
loans.
get RMB reserves? From its trade with China? So it buys things from
Yes.
China in RMB? Okay. Do we know if the Kenyan Treasury has multiples of billions of dollars in RMB reserves that they can easily swap these loans now to pay in RMB instead of dollars?
Okay. The way I understand is that they don't, but I don't know whether they can get them. I know that in some of the cases in Ethiopia, I believe in some of the earlier day loans that they borrow in RMB from China Exim banks, they use some of the Ethiopian airline revenues, because they have flights coming between Beijing and Addis. They use that revenue to lock in those to repay some of the project loans. But the thing is that it depends on how Kenya manage it. If they don't have the reserves, the way I understand is that they don't have it now, they would have to buy RMB with US dollars. So that comes a risk. So if the RMB appreciate, they have to use more dollar to buy the equivalent of RMB, if that makes sense.
But if they're using dollars to buy RMB, aren't they just still spending almost the same amount in dollars? I mean, again, help me understand this. I'm a 6-year-old when it comes to understanding these finance matters. Because if they have to pay back, say, $3.5 billion in US dollar-denominated loans, but then have to spend $3.5 billion in dollars to buy yuan, where do the savings come in?
So the savings mostly will come from the interest payment, right? So on top of the principal you just mentioned, you have to pay the interest, which is accumulate based on your outstanding. So right now, if they convert, again, we still don't know if they convert most of these floating rate US dollar loans to floating rate RMB loans. The benchmark of the Chinese RMB will be lower than the US dollar. So actually, when you pay every 6 months, at least for now, your interest payment to China would be less than in US dollars.
One of the issues that is also complicating all of this is the surging trade deficit between China and Kenya. We just got some numbers this week that showed that Kenya imported in the first 6 months of the year something around $2.4 billion worth of goods from China and exported out only $68 million worth of goods. And this has been consistent over the years, this stark imbalance. The reason why that's related to what we're talking about is that the Kenyans are using a lot of dollars, I presume, to buy these Chinese imports, not yuan. And as a result, their dollars are going out the door. Now, their cash reserves in the Forex bank are quite substantial. So they do have some multiples of billions of dollars to be able to use on this. But they do have this very large trade deficit with China that also seems like it could potentially put a strain on their ability to spend a lot of dollars because they're spending a lot on imports.
I agree with you. I believe that the Chinese government want to encourage country to use RMB to settle the trade with China, but again, with large trade deficit, they wouldn't be able to accumulate a lot of RMB reserves, even if they want, right? So, it's a structural problem. It has been there for a long time. You saw that the Chinese government tried to eliminate all the tariff for African export to China. I believe there are a lot of people try to solve that problem or try to at least address these structural this issue you talk about. But again, when it comes to Kenya, and not just Kenya, for a lot of countries in Africa who was looking at this kind of deal, if they don't have reserve, if they don't have RMB reserve, they have to factor in this risk of the RMB appreciation. I don't know whether they have done enough of that. I hope they do. If not, they should be thinking about it. That's also, I believe, a lot of people, even in China, also have doubts about this kind of deal, whether they should do it more, across the board with other countries, right? If the Chinese benchmark rate, we don't even talk about the RMB appreciation. If the RMB benchmark rate got increased again, it can be higher than dollar. I mean, are they going to swap it back to dollar? So that's the thing. So it provides some liquidity support, but there's a lot of uncertainty out there, and the country have to factor in this risk.
And that uncertainty is probably compounded by the trade war with the United States. Depending on what happens with China and the U.S., the value of the yuan may go up. So again, let me recap just so I understand. This is not a risk-free proposition for a country like Kenya. So there's a lot of excitement right now about the potential savings, but given if you're switching into yuan, the yuan appreciates, those savings evaporate pretty quickly. So what do you think they can do to hedge against that risk?
It goes into a lot of financial terms. I'm not expert on, but I believe they can, sure, if they want, they can get this cross-currency swap, try to lock in this buy future RMB with US dollar, to lock it at some kind of certain rate. But first of all, there will be a cost if they do that, and it may potentially wipe out at least some of your savings from this operation with China. That's the thing. But the way I understand it is that when I talk with some African country, they still see that, okay, the RMB and US dollar rate is kind of stable in the past couple of years. So, I mean, they believe it's worth the bet, right? So you also have that thinking out there. I know that, China already lent quite some RMB loans back in the days. I was just looking at this data. So about 10% of the Chinese overseas loan commitment in the past 20 years, it's in RMB. 10% of their overseas lending is in RMB. Among those, 4 percentage point is this concession loan from China Exim Bank, right? The foreign aid concession loan, 2% in RMB. The way I understand it, for a lot of countries, they have been paying those RMB loans just using dollars. They just pay Exim Bank dollars directly. So they have to take in the risk of RMB appreciation. But when it's 2%, nobody cares. But right now, if it's a floating rate, then the risk is more significant, I would say.
I guess that's a little bit like an adjustable rate mortgage. So I have a mortgage locked in at 4%. That won't change. But if I used an adjustable rate mortgage, depending on the interest rates in Washington, then the rates can go up or down because the value goes down. Okay, that makes sense. When we talk about the debt distress that Kenya was facing, and I talked to some folks from China Exim Bank a couple of years ago, and I said, why don't you just restructure some of these debts from these loans from Kenya, cut them some slack, give you some good positive PR. And their response was, and I thought very interesting, they're like, why should we do the debt restructuring when they're paying back all of their Eurobond debt, their domestic bond creditors, everybody else? Why should the Chinese be the ones singled out to take the haircut? And I thought, oh, well, that actually makes sense. And that points out the fact that the Kenyans have been quite good, very good, in fact, in servicing their loans. Let me just give everybody a quick update on where we are with Kenyan debt as a total. $93 billion is where we stood in July 2025. That is a number that has been steadily rising by 10, 15% every year. The debt to GDP ratio is about 68%. That's probably going to go up as well. That is well over what the International Monetary Fund likes to see at about 50%. So Chinese debt as a percentage of the total of Kenyan debt is about 4% now. Very, very small. Yet there are still lots of concerns about debt traps and China taking over lots of things. But you can see they're a very small percentage of the total. When we see what the Kenyans are doing in terms of restructuring their Chinese debts, do you get the sense that they're also trying to do this with other parts of their debt portfolio as well? Or are they specifically focusing in on Chinese loans?
So yeah, actually, it's a good question for Kenya. Okay, I just want to put some numbers out there. So I think you're talking about all the Kenya, debt, but mostly when people think about debt restructuring, they only look external. For China, the number I have here,
of course,
from World Bank, at least 2023, by the end of 2023, China is something like 17%, while the bonds is something like 12%, right?
Of the external, I mean, that's the external
yes,
debt.
Exactly,
I was saying of the total public debt.
And right. MDBs.
I mean, but yeah. No, the one thing I get frustrated on when we have a discussion about Kenyan debt is oftentimes, and I confronted a New York Times reporter on this who selectively said, well, China accounts for something like 70% of the bilateral debt. And the point that I made was that, well, that's true, but Kenya doesn't borrow that much bilaterally. Yes. Kenya borrows 50% from its own people. It borrows from Eurobond creditors, also from multilateral development banks, and then China. So how we slice it is very important. So that's why I choose to put it as a percentage of the total. Yeah. Rather than a percentage of bilateral or external, because there are so many other variables.
Exactly. I would like to mention that MDBs like World Bank and also account for 42% of the external debt, and IMF is under 6%. I know that, we don't talk about this MDB in debt restructuring, but I think for Chinese, sometimes they would think about what about others, right? So again, I think you're totally right.
That's right. And that's what the China Exim Banks, my friend at the China Exim Bank said, what about the others? Why are they singling us out for debt restructuring when the others aren't being called on to do the same?
Yeah. I think you're pointing to something, the Chinese keep talking about again. In the case of Kenya, I believe that's what the debt rescheduling negotiation took so long. I know that we hear here and there that they are asking for debt rescheduling, but the way I understand it, these formal negotiation didn't really start until quite lately. I think partly also because Kenya want to avoid the image of debt restructuring, and they want to still borrow more, right, for the SGR loan for the next phase. So I think all that you play a part in their thinking. But yes, I do see that Kenya tried to, for example, issue new bond to buy back some of the old bonds. Because they are not getting the IMF loan, it seems now, at least. So they are trying to somehow, wait at least until the elections. So I know that they are still negotiating with IMF, but there are a lot of doubts out there that whether Kenya really want to do these tough reforms, including add taxes and so on. Especially with election coming, it will be more difficult for them to actually do that. So right now with this China small maturity reprofiling, and then with these debt buybacks, they actually have more foreign reserves now. It seems like they have enough to actually hold on till after elections. But yes, I believe China's looking at the whole portfolio, trying to be helpful. But they also understand that this is not just about China. Look, like China rescheduling wouldn't be able, solve Kenya's problem, at least to the Chinese. And I think that's why, at least some in China started to see the benefit of IMF, right? Of course, IMF, nobody likes IMF that they have to go in and ask Kenya to do all these tough things. But as a creditor, you actually might see that what IMF asked Kenya to do actually is in your benefit. One would argue that, at least. Does it make sense?
Yeah, it does. And should we expect now that this is under discussion in Ethiopia, potentially under discussion in Indonesia? Should we expect that maybe Djibouti or the Republic of Congo or Ghana or Nigeria, all of these countries have, sizable Chinese debt portfolios? Would we expect similar currency swaps, or do you feel that this is maybe a trial case and they're going to see how it goes and then they'll determine if they're going to do more of this later?
Again, like I said, I don't see it right now as a kind of top-down, full-fledged campaign to swap all of that. But again, what's interesting right now, I was even surprised to a lot of people in China, is that, look, a lot of countries got interested, and somehow they don't worry about this risk of RMB appreciation or this interest rate increase in China. But each case is a bit different, right? In the case of Ethiopia, you might know that China Exim Bank is busy finalizing their common framework, like debt relief for Ethiopia. So if you add this on top of that, it would affect how they calculate this thing called comparability of treatment. Basically, is that if you provide more relief, and the Ethiopia may have to ask a bondholder to take similar, level of relief, and that would further complicate things. So I'm not sure how the Ethiopia case will play out. Again, in other case, case by case. In Ethiopia, we know that they already rescheduled the railway loan. The IMF report mentioned something in 2019. But if they want to do another round of relief, asking to cut interest rate by switching, it makes sense, I would say. But I don't know whether, Exim is willing to do that. Again, it comes down to country's negotiation. And again, like if you look at like Sri Lanka, they're not getting a better deal, right? They're having these preferential buyer's credit at 2%, 2.5% fixed in dollar. Now Exim said, I don't want to lend anymore. If you want me to lend more, I'm going to do RMB floating rate, and it will be more expensive. And so I believe it's still a country case by case discussion, and just wait to see.
And it's interesting that you bring up the common framework. And if people aren't familiar with the common framework, that was the G20's initiative on debt restructuring, which really was a very modest success, if you can even call it that, coming out of the pandemic. And Ethiopia, Ghana, and Zambia all went through it. And I think Sri Lanka did not. Is Sri Lanka a common framework country as well?
Not. It's not.
No, that's what I thought.
Yeah.
But that does complicate things. And the situation in Kenya is rather unique in the sense that it's a sovereign to sovereign debt restructuring. You don't have a common framework politics that are going on with the bondholders and others, or you have a situation like you had in Zambia where you had multiple, up to 16, 17 different Chinese creditors at stake. Here you have one Chinese creditor, one government, no common framework committee, and so therefore it makes it much easier to negotiate these deals. Other countries may not fit that same profile and that ease. And that's why, again, also in Indonesia, it looks like it may go through. So I think your point is very well taken that we should look at the dynamics in each country before suggesting that this may become a template that's used. What is the most important thing that you think we should know about this process that we're seeing now in terms of Chinese loans? Is it the fact that the yuan is now becoming front and center? Is it the fact that the Chinese are willing to negotiate more? What's the big takeaway from what you're seeing in this story?
The big takeaway for me, for Kenya, is that they may not have gotten the relief that they really want, which is deeper reprofiling. To me, the big message here is that for a lot of people, the worry is that, is this kind of thing enough? For Kenya, a lot of countries, I would say, even though the IMF labeled them as high risk, a lot of them in Washington here, at least see their debt as unsustainable. They suggest the IMF should have pushed Kenya to restructure. There are a lot of different opinions about whether the IMF should go tougher. I would say that we just need to, first of all, for debtor country, they need to factor in this risk of RMB appreciation. They should have. I shouldn't say good advisor, but they should really weigh the pros and cons and see, unless they can have some way to secure some RMB reserves from some project for this repayment. Otherwise, they have to factor in this risk of RMB appreciation. For China overall, I see this as still kind of like, well, it's good, but it's kind of kicking the can down the road again. You're not, it's a relief, but it's not, it may not be enough for the IMF at least. So that's what I would say is that if you prefer these bilateral debt treatments, it may be enough, it may not be enough. But a lot of people may argue that maybe China should wait. If Kenya need to really do their restructuring, then do a deeper restructuring with IMF and China, and it can calculate how much is enough. But here is that you provide some relief, but it's hard to know whether this is enough or if they're just kicking the can down the road.
Okay.
Yeah.
Well, that's a good takeaway. I did not understand the risk that's involved with the appreciation of the yuan, and now this is a floating rate loan, so it potentially could wipe out some of those savings. I think that's a very important takeaway. I do hope, for the benefit of the Kenyan taxpayer, that President Ruto and David Ndii, the chief economic advisor, are being well advised on this, because you hope that they don't kind of move from the frying pan to the fire, where they get into one high rate loan and into another one, given the appreciation of the yuan and the instability that we're seeing in the international market.
Eric, I will also add one more, is that I think, again, I think for debtor country, they should know that these Chinese banks are in a difficult situation. I sometimes feel like this is not like emphasized enough. Because for most of these loans, is unlike these traditional Paris Club countries. If they do debt relief, they will get kind of budget support from their government or for their Congress. For China right now, they don't have a set process to how to compensate these banks. So you're asking the bank to do a lot of relief at a time that they're really new to this world of debt restructuring and debt relief. And the big message, another big message I would say, is that China is willing to negotiate. That's the thing, right? So if you need help, they're willing to step in and negotiate and help. And this may not be enough, but maybe in next round, they can still ask China for help. I think that's another big message here, is that, I mean, they're not trying really hard to squeeze Kenya, if that makes sense. And they're not trying to get any even geopolitical favors, I would say. So it's just that a difficult, the banks are in a difficult situation. That's I will put it. I think they're trying their best to help Kenya. But
the fact that the banks don't have a government backstop or a government guarantee to make them whole in the event that they lose out may explain exactly why the China Exim Bank and some of these other Chinese creditors are pulling back so much on their lending to higher risk countries.
Exactly.
Okay, so that makes sense. Whereas, say, some of the Paris Club countries, the taxpayer comes in if these loans fall through. But you're saying that in the China Exim Bank and some of these others, the taxpayer doesn't necessarily come in to save them if there's a default.
At least not now. But again, Eric, I think people wrote about it already. It also took Paris for a long time to accept the fact that they have to do debt relief and cancel some of the debt. And China only been through this process for 2 years, and some of them still have doubt about, do we really need to cancel this? Do we really need to do a deep debt relief, or can we wait for a couple of years to see whether things improve? I think these lessons, the Paris Club have their own lessons, but it may need time for China to process that. Sometimes they may need to do deeper relief for country in need. And otherwise, they wouldn't be able to get the money back. But it will take time for them to process this. Yeah, I would say.
Well, it's much more complicated and much more fascinating than I think a lot of people appreciate. Yufan Huang is a pre-doctoral fellow at the China Africa Research Initiative at Johns Hopkins University, and together with Professor Deborah Browdegum has done some fantastic research on this topic and helps to make us all smarter about it. Yufan, thank you so much for your time today. We really appreciate it.
Thank you, Eric.
And we will be back again next week with another edition of the China in Africa podcast. If you'd like to follow all the great work that the team at CGSP is doing around the world in Africa, Asia, Latin America, covering these issues like the Kenyan debt crisis, go to ChinaGlobalSouth.com. And of course, if you would like to support the work that we're doing and to get a daily digital digest and the same briefing that about 25 governments around the world are getting every single day into their inboxes, go to ChinaGlobalSouth.com/subscribe. And if you are a student or a teacher like Yufan, you get half off. Send me a link, send me an email, and I'll send you the links for the discount codes for students and teachers. So that'll do it for this edition of the show. I'll be back again next week with Jero and Cobus for another edition of the China in Africa podcast. Until then, thank you so much for listening and for watching.